Jessica Solomon here with my colleague Mark Myman. I have over 20 years experience in the senior care industry, and Mark has over 20 plus years in the mortgage industry. And I think it's important to kind of just give people just to um, kind of ground the crowd is how Mark and I connected is because after so many years in senior care and working within the ecosystem, I started seeing some things, some patterns in the industry that was happening and where it was headed. And Mark, who is in a completely different industry, started seeing the same thing at the same time. And so in, with our experience, and I started looking for solutions for families that needed funding sources to pay for care. I saw things that were happening in the market. And like I said, Mark was in a completely different industry at a completely different time. And what we found is we wanted to start working together. We started connecting professionals together, and we started to realize that we were so deep in our own silos that the only way to educate people was for us to kind of get together and collaborate. And that's how we got here today. So thank you. I'm looking forward to going through this presentation with you. I'm really looking forward to any questions that you might have. We would like to get this as interactive as possible. So if you do have a question, put it in the chat so we can discuss it. And Mark, if you want to introduce yourself.
Sure. Yeah. Hi, everyone. Mark Myman. I see a couple of familiar faces on here, which is nice to see. As Jessica mentioned, I'm just shy of my 25th year in the mortgage industry. I have the gray hair to prove it. And like Jessica said, we
Oh no.
started seeing some trends happening with our clients that we really saw a significant need. And so when we see a significant need, we try to find a way to help people to be able to overcome that challenge. So Jess and I teamed up a couple years ago almost, and really excited to tell you guys more about different ways to fund senior care. I think one of the biggest challenges is that senior care is not getting any less expensive. And a lot of people find themselves in situations where their home is their biggest asset, and but they don't necessarily look at it as an asset in the same way that they would other types of assets. So we'll go through those in more detail. I don't want to jump ahead here, but that's what we're here to talk about today.
Mhm. So I think that what we learn over time, if you've and again, if you've been in the industry for over 20 years, if you've been in the senior care industry, that you realize that a lot of these decisions, these big decisions, are made by families in complete isolation. And I saw somebody on LinkedIn describe senior care almost like global warming. It's like some people we have evidence that it is happening. We see evidence in weather patterns and things like that, but some people just ignore it. And then some people are like, well, what am I going to do about it? And like, when am I going to do something about it? And I thought it was very interesting to compare that to senior care because we're all aging, we're all going to age. Nobody's getting out of here alive. And but for some reason, especially if you're a professional in the senior care industry, you know that every time a family comes into this event that happens in their family's life, it's the family that is making these decisions. It becomes very emotional. It becomes very, static and untethered. And so the family or whoever is close to that person in need of care has to make these decisions that happened on impact basically. So families are still, after 20 years in this industry, what I see is um, it's getting more complicated, it's getting more complex, it's getting more expensive, and yet people are still more shocked every time this is happening. So something's wrong when people are entering into a system and they have no clear idea of what the next steps are. And we see more of that all the time. And that's what I was saying from senior care. So do you want to take it, Mark?
Yeah, so I think what Jess and I try to do is connect those dots between different professionals to try to break down those silos that she was talking about. So, for example, people turn to a real estate agent to sell their home without consulting with a tax advisor to understand what the implications are potentially from a capital gains tax perspective. And we'll show an example later today that will kind of illustrate a more extreme example, but one that had a very significant impact on a family, and had they gotten proper advice with the right advisors, that's something that's a problem that could have been easily avoided. So Jess and I have collaborated really with a mission to help on the professional side, to help break down those silos, to get, for example, again, real estate agents to understand capital gains tax, because it's important if you're serving seniors and their families to understand those things, to be not necessarily to be the expert on the tax code, but to know when something might trigger a tax, at least just to raise a red flag. So Jess and I have worked very hard to curate our network of people with the intent of trying to support seniors and making sure that people are making fully informed decisions. That's our goal.
Well, and if you listen to some of the things that Mark said, it could be like wildly like, what did he just say? What is he talking about? And Mark on the flip side of that is the same thing as Mark and I have spent the last year and a half. Well, we've known each other for years, but like really, Mark has immersed himself into senior care and getting connected in the senior care market to really understand what professionals that are in the senior care ecosystem are dealing with when they're talking to families. And so I'm trying to, where Mark is trying to take the information that we know to other professionals that we work with, like the real estate agents and some of the elder law attorneys. We're trying to kind of find a way to communicate and educate to an ecosystem of people that are helping. When you're in the ecosystem, senior care, people are making big financial decisions. Yet a lot of the people in senior care are not financially literate themselves. So that's the connection between Mark and I, what we're trying to do. So I have an example here regarding where I live in Santa Barbara, California. And I started in the senior care ecosystem in 2004. And so I wanted to do comparison so people have an idea of the difference between what has happened in the last 20 plus years. If somebody was in a skilled nursing, if a parent was in a skilled nursing, a convalescent hospital, at that time, they might have had a shared room for $250 a day that they had to pay out of pocket. And I would say to the family, how about for $50 more a day, $300 a day, I can get you a live-in caregiver to go home with your mother. And so for a lot of families that says, well, we're paying $250 a day. Yeah, I think another $50 a day to get my mother in her own home with one-on-one care. That makes a lot of sense to me. I'd like to do that. And it was a little bit affordable and digestible at that time, even if you were talking in terms of long-term costs that was digestible. So now in 2026, you might, if you're working with an agency, it's going to cost you at least $1,200 plus a day. You're going to have at least two caregivers in the house between two 12-hour shifts, maybe sometimes even three 8-hour shifts because of labor laws, because of um, overtime, because of lots of different things, is like that's what the cost is. So just to kind of understand the differences, if you want to stay in your own home and you need support for 24 hours a day, we just went from 300 to 1200 plus in 20 years, in almost 20 years. And then is $1,200 a day really affordable for people, a lot of people? So we don't have the same staff that we used to have, so we don't have as many caregivers. We're in Santa Barbara market. One of our issues is that we're carting in caregivers from different communities or different counties. And so that's a big issue here because it's not very affordable. It's a very affluent area. Um, we used to be able to cover certain costs for caregivers, like their transportation and things. There's other dynamics around that. Because we had bigger caregiver pools, it was easier to staff things. Now it's difficult. We used to have maybe 2, 3 hour minimum staff to staff a case with a caregiver. Now some companies won't do less than 6. So we had a little bit of a more sustainable care model within our ecosystem, but now what's happening is there's rising costs and there's less caregiver ability, and it's a little bit more challenging. So that's what we want to show you is the differences from the senior care system. If you're a family entering into this today, you are entering it like not like what it was 20 years ago. So immediately you're being told that if your mom needs 24-hour care, it's going to cost you over $1,000 a day. And this is a shocker to people. So assisted living, same thing. The average cost here in this community is $3,000 to $5,000 a day. I update a list here in the community that shows all the starting rates, and between like just in a couple months, a few rates have gone up a few $1,000s. One community that was $9,000 a month a few months ago, is now just changed to $10,000 a month. We had a brand new special rate for a new community that opened up in Solvang, California, or Buellton, and the opening rate or the discounted rate was $10,000, $10,500 for one room in a house. So that's kind of what the rates are right now. Again, has gotten extremely expensive, and even the assisted living communities sometimes have issues with caregivers. So you want to do the next slide, Mark? So we just want to kind
Mhm.
of give you a snapshot. Um, so I think that's the same one, no?
Yeah,
Yeah.
sorry.
Okay. So okay, Mark, this is where
Yeah,
it comes in. This is what makes it very a little bit relevant to my area.
yeah, exactly. So we want to explain, we want to make sure that for people who maybe don't fully understand what home equity means and how to utilize it, we're going to basics here. So we won't spend a lot of time on this, but you see here a few examples of different situations where people may have a home value that's more moderate, but they have a fairly high loan balance. The equity is the difference between the value of your home and the amount that you owe on it against that's in loans that's secured. So typically a mortgage or a home equity line. So whatever the difference is the amount that you could potentially borrow. Now, banks won't lend you 100% of the value of your home. They'll usually lend you 80 to 90% maximum, but you kind of see the differences. So this is why these scenarios look different for every family because the home value could be vastly different from one property to the next or one client to the next, as well as the amount that they owe on the property. So you see here just kind of a few examples of how much equity they have. What's more important than the percentage is the dollar amount. So if you have a home, for example, if the average home sale price in your area is 300,000, even if you don't have a mortgage on the property, you might only be able to borrow 200 to 250,000 against it. Whereas if you have a home that may have a existing mortgage that is 50% of the value of your home, but your home value is so much higher, you may be able to borrow more. So that's why these are all very unique scenarios, depending on where you're located, where the family's located, plays a big part in how much dollar amount of equity is actually available to the family to potentially borrow against. And then obviously, in addition to equity that could fund care, you have all sorts of other types of assets. Real estate is an asset. Oftentimes people don't look at it in the same way that they look at a savings account or retirement account, an IRA, things like that, jewelry, artwork, cars, all these types of things are assets. They're tangible assets that can be either sold or leveraged. But there's lots of different ways to do it. But people oftentimes don't look at real estate in the same way as they look at it, for example, an IRA, because it's a different process to be able to access it. But sometimes it's also more tax advantageous to do that. So we just kind of wanted to illustrate the different types of assets that people might have. And again, another few examples of people that may have a lot of equity but limited assets, some that are kind of more moderate, and then others may be more wealthy on assets but have less equity in their property to pull on. And these people may have different solutions of how they would fund care depending on their specific profile.
I think also I just wanted to say is like this because we have such a wide audience on the phone, it's like that, like Mark said, that could be very, very basic. And this could also be very new news to a lot of people. Well, what we want to do is we want to not only try to explain to the audience what we're trying to do, we want to give the senior ecosystem the tools to explain this as well. We want this should be basic literacy that everybody knows. And the reason why it's important is because when you're spending a lot of money on care, you need to be very clear on what you're spending it on and if you can't afford it. So I really believe that this period in time that the people, the businesses need to I think clarity is kindness. And if we're really helping and serving people, we need to create clarity so people understand what it is that is going on right now and how if and they can't afford it, we need to be transparent about costs because I feel like that's how the market is gonna and people and consumers and families are gonna be a little bit more prepared for what's is happening right now. It's not, when it's gonna happen, it is happening. So that's so if anybody ever has, they have comments or they think like, why are we getting so basic? It's like we just want the feedback to help people explain it to others as well.
Right. Exactly. So some of the most common mistakes that we see, and let's just assume in some of these cases that somebody is looking to take out a loan against their property to fund care. One of the biggest issues that they don't have a proper power of attorney or a trust in place, and that can cause all sorts of problems. Because in the event that the senior does not have mental capacity to sign on their own behalf, if there is no power of attorney set up for someone else to sign on their behalf, you're really in a tough bind. Financing may not be viable. Healthcare decisions maybe have to be made by somebody that you don't want to make them. So for anyone who does not have that in place on the call, or if you have family members who do not have that in place, that is a very, very critical thing for lots of reasons, both healthcare and financial, because you need to designate someone who can operate on your behalf and who's legally authorized to operate on your behalf if something were to happen to you. I think one of the biggest issues we also see is that families don't plan ahead. They act in crisis as opposed to staying ahead of events. And that can cause lots of problems as well, because again, similar to the power of attorney, if you're into a major health crisis and you haven't designated the right people and you haven't planned ahead to be able to potentially access equity if you need to, in advance, you may not be able to so easily when you're in that crisis moment. Another mistake we see, and again, we'll give an example of this later, is selling the home prematurely. So oftentimes people think, okay, I need to pay for care. Maybe I'm moving into assisted living, or maybe my family member is. And so I need money. I have this very valuable asset in real estate. So I'm going to sell the asset to pay for the care. It's a natural thought pattern. But again, this goes back to the silos that Jessica and I were talking about earlier. Oftentimes, there are potentially significant implications of selling that home prematurely. For example, it could trigger a taxable event where you have capital gains tax that could be avoided. I think maybe Jess, we should touch on the
I
step
think
up in
also
basis, yeah,
I
a
think
little bit.
that I think to relate it to the community we're speaking with is here's something very common when I was worked in home care that we would have a family on services and abruptly, they would sell the house because they have to place the family member because they can't afford the home care anymore. I'm not saying that they should or they shouldn't have. I'm just saying that that happened a lot. Also, we have family members that would come in um, that hadn't seen their parents for a long time, and then of course they go, "Oh, I haven't seen that." They see their family during the holidays or Mother's Day, and then they see, "Oh, they need to go into a community." I can see that they're not able to care for themselves anymore. So, again, a child coming from away is like, "Oh, we need to sell the house," because the natural flow um, or thought process for a lot of people that don't have the education we're trying to give you or share with you is that if you need money for something, you sell this to buy that. I need to sell this house to buy care for my parent in assisted living. That that is a factual statement. The part that we're trying to tell people is like you may want to consider selling the home on a later date or not sell the home at all because, and now Mark, you can start telling about the step up basis.
Sure, sure. So one of the things that oftentimes families don't know about is, and I'm going to grossly oversimplify this, but if you sell a property while the senior is still alive, they're subject to whatever the capital gains tax may be. And a lot of times what we find is that the aging population today is what I call a buy and hold generation. So many of them have owned their homes for many years. And what does that mean? It means the property has probably appreciated a lot. And therefore, they are likely to be subject to some sort of capital gains tax in the event that they have owned it for long enough and it's appreciated enough to not be under the cap for how much the government allows you to have in capital gains without actually having to pay the tax, which is 250,000 for one person, 500,000 for a couple. So in the event, and again, grossly oversimplifying this, you sell the home the day before the senior passes away or any time before then, you're subject to the full amount of capital gains tax. If you sell the property even a day after the senior passes, that capital gains tax could be completely wiped out. So if you have a family that bought a house 50 years ago for $20,000 and now selling it for $1 million, and you sell it while the senior's still alive, you're going to pay taxes on it. If you
Yeah.
sell it while after they pass, you would likely pay zero in capital gains tax.
So
So
after the education that Mark gave me, if I was speaking with a family, and there might be some people here who are seniors too, need the education to understand that. Or so a lot of people, just to digress, right, a lot of people say, "Oh, I have a will," but that's not an estate plan. There's a difference. And so people um sometimes think that they have everything in place. That's a big problem that we've seen over the years too. But if I was speaking to a family that says, I um, we don't have an option, because we just don't have anything else. And, we're have to, well, and we're gonna share an example. And I would say, what I wish I would have said to families was, I didn't know anything else about except for reverse mortgages at the time. And I would never tell a family to do that because that's just one option. And I don't know if it's necessarily the best option because it had a bad rep for a long time. But what I would say now to a family that is considering that, say, you really need to understand the tax implications of doing that. You really need to understand is if this is all your family's got, this is your family's last financial anchor. So you better play or leverage this correct way for your family, for your parents' care, for your parents' legacy, for what the family had anticipated. Sometimes we can't anticipate these things. It could go left or right. That's life. But what we're seeing that's wild and rampant across the board right now because of the stage and age that our society is that these mistakes are happening every day across the United States. And a lot of it has to do with the fact that we're all in our different silos, real estate agents, lenders, senior care, senior living, assisted living, home care. We're all operating in our own silos. And so we don't realize it's total innocence. We don't realize that the predicaments that we're putting families in when we don't have this education, basic education. We don't have it's like blind leading the blind. That's why we all have to kind of start collaborating together and sharing this information so that we're helping people just make more informed decisions. A family is going to make whatever decision they're going to make, but we want to at least equip them with the
Yeah.
better.
And to make sure that they're not making unnecessary donations to the IRS by making poor
Exactly. Yeah,
decisions.
we're gonna
That's what
get
we
to
want
that
to
one.
avoid.
I think that's an eye-opening these because we have examples of these mistakes that people make. We have actual examples, and I think that's the best way to teach people. We can tell people to be aware, and this could happen, and you should plan. And as we know, nobody's planning enough, because people don't know what they don't know. But we can teach people mistakes that people made, and that's when you start getting people's attention.
Right. And to just touch on some of the other common mistakes that we see people make is not that liquidating investments is always a bad idea, but liquidating investments before you understand the other alternatives. So in some cases, if you're liquidating prematurely, you could be paying, again, capital gains tax on those investments, which could be 30%, sometimes more, depending on what state you're in, if there's state and federal taxes. So liquidating funds without looking at other alternatives to pay for care, which might include funding, might include other options, is a big mistake we see people make. Also, seniors who assume that their family members want to keep the home without actually talking with them about it. They might make decisions because they think, oh, well, my kids really will want this house when I'm not here anymore. And that may not be the case. So that's an important conversation to be had. And also just understanding the true cost of care. I think people are often surprised, and Jess, this is more your territory than mine, but people are often surprised. They had no idea how expensive it was, and they didn't plan ahead, so they weren't really prepared for that. And then they're acting in kind of panic mode rather than preparation mode.
But this is like all across the boards. This is insurance for people. This is other expenses across the board for everybody. So it's no different that like care is getting exponentially expensive and cost prohibitive for many people. And a lot of caregivers, especially Gen X now, not, the responsibility that's weighing on Gen X is unbelievable because nobody anticipated this even though we had enough evidence that it was going to happen. Bill Davis has a question mark. I don't know if you wanted to answer it.
Oh, yeah, if you don't mind reading it just because I'm sharing
Oh,
my screen.
so Bill said, Allie Elliott asked, what if a couple co-owns a home and one of them passes?
Hmm. There's something called a partial step up in basis when one of them passes. So you get a partial reduction of potential capital gains tax, which might be enough to wipe out the capital gains. It just depends on how all those numbers pencil out. And in
And
full
then
disclosure, I'm not a tax accountant.
yeah.
I'm just giving you my understanding of the tax code and how that works.
And then there is the appraisal at death, right? There's a,
Yes. Yeah. One of the best things, smartest moves you can make is when a senior passes away, whether it's a couple and one of them passes or both of them, or the last remaining family member passes away, you can do something called a date of death appraisal, which is an appraisal based on that date, to basically be able to document for the IRS what the home was worth on the date that they passed away. And that's relevant to calculate how much tax may or may not be available. If you leave it to chance, the IRS might not agree with your approach. So having that date of death appraisal is a really important step. It's a $500 cost that could save you tens of thousands of dollars in the end in taxes.
okay. Then there's, and then Bill Davis says there are potentially two step ups in cost basis in California as a community property state,
Mhm.
maybe, no, and with the decease of each spouse unless joint tenancy.
Yeah, like I said, there can be multiple step ups. If a couple owns the home, there's larger deductions that you get as a couple if you're selling a home rather than as an individual. So there's lots of different ways to cut this. I certainly wouldn't be the one to be able to advise somebody, but we know enough to raise a red flag to say, hey, this is a conversation you need to have with an accountant, the CPA who understands all the implications and all the different decisions that you make. It's just important to have that financial team. It's the tax people, it's the financial advisors to decide, help you decide, should I liquidate investments or should I potentially take a loan against my home? People naturally think, well, I'm borrowing money, that's bad. But not necessarily if you're avoiding capital gains tax of 30% by liquidating the investments, and every $1,000 you take out, you lose 300. That's worse than paying 6% interest, for example. So the idea here is that families need to have the proper advisors on their team,
Hmm.
or at least as they're making these big decisions, need to be making them with the types of professionals who can advise them. Hopefully, those in an absolutely ideal pinnacle situation, those advisors are communicating with each other as well and
Hmm.
collaborating to make sure that you're making the right decisions, because many of them are irreversible. Once you go down a path, it's not so easy to reverse course. If you sell your home, you can't take it back. It's gone.
I, I think that what Mark taught me is that um, in the senior care ecosystem and coming from like care management model and that the care manager is seen as a quarterback for the family that's aligning all these other services up. But I had never once seen a care manager identify any of these financial um, red flags for a family ever. I didn't know about them. I didn't know anybody that I worked with that knew about them or talked about them. And what we learned over time is that there's a lot of real estate agents out there that we've talked to them, and 50% of them absolutely do know and understand what we're saying. 50% don't. And that's a huge red flag because we can't play like pin the tail on the real estate donkey anymore. You just can't do that. And so I think what I appreciate about knowing Mark and where he comes from and being in a highly an industry that's has levels of compliances. Mark doesn't not just know his lane, he identifies that it's really important that if you don't have a tax accountant, we can provide or recommend or whatever. But the fact is that you can't be very educated about your decision if you don't have all the professionals giving their way in, and even better if all those professionals are working with each other.
Right. And I think oftentimes families also think, like, on the financial advisor side, that if you're not investing, if you don't have millions of dollars, then a financial advisor isn't going to talk to you. There are actually financial advisors who you can hire by the hour just to run specific decisions by. I mean, I'm a big fan of having a financial advisor in general. But if you don't want that for any reason, there are people you can hire to just run very specific decisions by before you make those choices. So highly recommend that for
Mhm.
sure.
Yeah, we're coming across the time to so this is a good slide because I brought this up, reverse mortgage. I only knew about reverse mortgages. I only heard about reverse mortgages um when it comes to seniors. I didn't think of anything else. So I didn't know that there's alternatives. I didn't know that talking to a mortgage strategist, there's a lot of people that do loans, but Mark's a mortgage strategist. He's like looking at the big picture. He's the difference between a care coordinator and a certified geriatric care manager. There's like levels of expertise and experience, and you're looking at this on a lot of different angles. And also, I think what's really important that you understand about the difference between, I think, Mark and somebody else is you don't have a Mark that's really immersing themselves into the senior care industry, but Mark's also curated all these different products and scenarios and ideas and solutions. And in Mark's portfolio or in our portfolio of products or solutions, reverse mortgages are in there. But Mark says there's other things to consider. So
Yeah.
um, I'm not knocking reverse mortgages or people that sell reverse mortgages because we do all as well. But here's the big difference that I'd like you to understand. There's reverse mortgage companies that just sell reverse mortgages, and then there's strategists like us that say there's reverse and there's other options as well. And I think that
Right.
if there's anything that you hear today, please hear that.
Yeah. And I think it's important to understand that reverse mortgages are heavily marketed. I'm gonna give you guys all a glimpse behind the curtain. Reverse mortgages are heavily marketed because they are by far the highest commissions of any loan in my industry. There's a lot of money behind them, and therefore a lot of ad dollars. And oftentimes, and I don't know if this was intentional or not intentional, but people oftentimes think that because I'm a senior, I don't have a lot of income, my expenses are greater than my income, I'm not going to qualify for anything else. This is my only option. And people will talk in that capacity. People in my industry will say, well, you're a senior. How do you expect to qualify? And there are alternatives, and if we have time, we can get into some of those. But I want to kind of talk about the good and the bad with reverse mortgages. So I always joke that the best thing about a reverse mortgage is that you don't have to make a monthly payment. And also, the worst thing about a reverse mortgage is that you're not making a monthly payment. Why is that? It's because what's happening behind the scenes is when you don't make a mortgage payment, which is the main point of a reverse mortgage, what's happening is your balance on the loan is accruing. It's getting bigger and bigger every month because they're adding the interest that you should have paid that you didn't to the balance on the loan. And what happens is you start paying interest on interest that you didn't pay in prior months. And so the longer period of time you're in that loan, the more interest you're paying on interest on interest on interest on interest. And you start to lose equity faster and faster to the bank. So you lose the amount that is quote unquote your share of that property value. The other thing I don't love about reverse mortgages is that it's the only type of loan that has a requirement that is for continuous owner occupancy, meaning if you don't live in the home anymore on a relatively permanent basis, you are required to pay off that loan. It's considered something that would trigger what we call due on sale clause. It's almost as though you've sold the house if you don't live there anymore. So if a family needs to change their care plan, maybe they were doing home care and now senior just needs to be in assisted living, or maybe it's a financial decision, who knows? But they have to move out of the house on a more permanent basis. That family has 6 to maybe 12 months with extensions to pay off that loan. How are they going to do that? That's not always so easy. Another family member can't just step in and pay off a $500,000 loan so easily, nor would they want to, even if they could. So it sort of forces people's hands to either stay in the home or sell. And that selling obviously can, as we talked about earlier, could trigger the potential tax implications. So it kind of handcuffs people to the house because it forces them to stay there if they want to continue to have the benefit of that loan. And that can complicate, care decisions and lots of other things. So it's also not transferable to heirs. So if your family legacy plan is to transfer that property to a family member, unless that family member can somehow replace that reverse mortgage with another loan of their own and qualify for that, it's not going to be conducive to handing that property down. So it's not always a great solution. There are other alternatives that I think people are not aware of because of the marketing dollars behind these programs. So we just want people to know that there is good and bad with reverse, but there's also alternatives that you may have no idea are even out there. So a few of the alternatives that we could talk about. One of the things I think would be the best thing a family can do as they're preparing for aging, maybe they're still in great health, maybe they're even still working, maybe not. But opening a line of credit on your house gives you access to be able to pull equity, so to draw money out of a loan. But the beauty of a line of credit is that you only pay interest when you actually use the money. But for most home equity lines of credit, you can draw that money for up to 10 years. So it's almost like a safety net that can last you up to 10 years. And if you don't end up using it, you don't end up paying interest on it. But having access to that cash in that crisis moment that we all know we can't really prepare for, we don't know when it might come, or if it might come, or if it might come next year or 7 years from now. Having access to the equity without having to actually pay interest on it is an amazing thing for families to be able to do. That is,
This
if yeah,
this would be kind of like, just to kind of draw it in the crowd. This would be like when somebody says, I need help, or how much it's going to cost, and it's like, oh, does insurance pay this? And you'd say, well, do you have a long-term care insurance policy? And he'd be like, yeah, great. That's wonderful. Now you have money to pay for that. This is, well, we don't have anything, but we did take out a line of credit. Great. That's your own money you're using that you access to pay for this. It's kind of
right.
like saying, like that, like great, you planned ahead a little bit and you have something that you have accessibility to. That's how I look at it now.
Exactly. And so that just gives you access to funds in advance of actually needing it. That's one of the few loans where you can open up the account so that you have access without actually having to borrow the money right then and there. Bridge loans are another common one where you need money short term, where maybe a family member wants to move into either downsizing to a smaller home or maybe moving into assisted living, but they need some funds to make that transition and they prefer to sell their home after they move out. We see this a lot with hoarding situations where the house just is not in the condition it needs to be in to be able to sell for top dollar. So bridge loans can help people make that transition a little more easily. Trust loans and asset-based loans are a little more complicated. I don't know if we have time to get into those, but they're situations where a family member may have incapacity and need to do a loan directly to a trust. Again, another reason why the estate plan is so important. That's another option you would not have if you don't have a trust. There's loans that can be based on how much you have in assets rather than income, which is usually the profile we see for most seniors. There's traditional, sometimes people will qualify for a conventional mortgage or they might have family funding. So when we're going through a situation with a family, we're asking, a fair amount of questions that are not on a standard loan application, like, how long are we expecting to pay for care? Is this a short-term need, long-term need? How much is the care each month and projecting out how much that might add up to over time? Um, and what if the care needs increase? So it may not be the same now as it will be in 5 years from now, or even 1 year from now. Um, and sometimes the care plan changes. So how do you plan for that? These are all discussions that we're having with clients and families as we're trying to prepare for the financing that they may need. Jess, you want to take this one?
To sell or not to sell. Well, I think that again, I've heard some when I was in senior care, it just came up on us so quickly because people are just assuming like they have to sell the item. And I want to give another example of um, somebody who, like actual examples here in Santa Barbara, somebody maybe a veteran that came here and bought a house here in the 60s and 70s. And, the house is worth like $3 million now. And the daughter comes in and, a veteran never had complicated estate, never had complicated taxes, never had complicated income. The family could probably do their own taxes, file their own taxes. They knew how much money they had. They had that in my savings account. They didn't feel like they need a financial advisor. So when a daughter of somebody in that situation shoots into this, like, what am I going to do with dad after he needs help? Um, Again, it's like a natural kind of, I'm in this emotional state and I'm not going to all of a sudden get the advice that I would from I just know that I've been told my dad needs 24-hour care, and I know we can't afford that home. And so it's just so, but what we would say now is you may be able to have dad stay in his own home, depending on, and assessing all these other things about him, like what is his condition, how can he stay along, how long was this going to last, how much is going to cost. We could maybe um, have your dad move into a safer environment that's more conducive to where the stage that he's at or he's going to grow into. But let's remodel the house and or put some money into making it an income property and renting it out. So if the family, those are different options. And usually a family is like so thrusted into this, like, I don't know how to do that. I don't know how to remodel this. I don't, so I'm saying is like these are things that the right professionals that are guiding a family gets all of these things together for them. It's just hard to make these decisions when you're in the middle of it. And I don't think that things are going to change I don't know how, I'm not sure based on what we hear is like we know estate planning attorneys that said recently, like we just get so many, we're getting flooded with phone calls. People are trying to order POA or durable power attorney like French fries. So we know something's on the rise. what Mark and I are trying to do is kind of find the areas to connect the people that are interested in learning about this because they're genuinely interested in saying, well, I know they really don't want to sell the home, or I know the family really doesn't want to sell the home. And that wasn't the idea that they had. That wasn't what the plan was for the family. And I think that we really need to understand is that we're getting a high rise of people that are mentally ill is a big issue as the aging population. That's another thing. So it's like hard to manage some of these decisions in families. But what we're seeing is that people are outliving their retirements and they don't know how to access capital. And they don't think that what they do have is going to last long term in a long-term facility either. So we need to get educated on these things. So I would say is if you're working with a family and they have a home, um, and you're creating a care plan for them or whatever the next steps, maybe people are going to be placed into, make sure that you understand that you are part of this process, that you are understanding that, there might be implications to doing this, selling the house too soon. Let's just make sure you have all the information. You're not telling them not to sell it either. Not saying that. Just saying that there is that understand what the implications are so they can feel like they have a plan for every part of this and not get understand that after the fact and not get negatively financially impacted based on a decision that you helped them make because you were unaware either.
Right. And I think we're running a little short on time, but I want to make sure we get to this kind of extreme example.
Okay, so
So,
so my
yeah.
so I had introduced Mark to I had a sales manager who became a placement specialist, a placement advisor, somebody who is guides people or tours people in senior living and gives them information, usually working with family members of their loved ones, and placed an individual, a 97-year-old woman, was placed into a community or care home. The family, this woman had purchased a house in the 50s, around 50 something or around that, very low price, very long time ago. And they just couldn't afford keeping her at home anymore. So they sold the house. They sold the house for $4.5 million in Orange County last year. But they paid almost $1 million in capital gains and closing costs because the real estate agent either had no idea, um, didn't think it was their responsibility because they were there to sell the house, and real estate agents are told to stay in their own lane, or they just, didn't care. We don't know what the experience or level of education that real estate agent, we don't know, but we do know that that family screw themselves out of $1 million and just handed
Right.
that to the IRS. And I don't think, I really got to believe that they didn't say, it's just $1 million. It's no big deal. I just don't think they did. Because that's how we found
Yeah.
out about it. I was like, oh my gosh. So we're living in a time, Mark says this a lot, that we are in a buy and hold generation, that the seniors, the baby boomers in the houses now have been in their houses for quite a long time. And so we have what they've accrued is a tremendous amount of equity. And the good news is it's kind of like when somebody goes, oh, you don't have a long-term care insurance policy, but you do own your own home. I feel like that's where we are right now. And that's what's happened when people have to pay for care.
Right. And to further go along with this story, had this family financed the way for the care to pay for the care for the 97-year-old who, let's hope had a many years ahead of her, but let's just say it wasn't that much time, maybe the cost of care would have been 2 or 300,000 and the family would have kept that, 7 or 800,000 in the family. I'm sure they could have put it to good use for something else. But
Hmm.
that was just a lack of knowledge. Again, we don't know if the real estate agent in that case knew the tax laws or if they just didn't care to bring it up. But this is why Jess and I are so committed to breaking down those silos. This is the kind of extreme example I was alluding to earlier, about how decisions you make with financing could actually be, with the tax implications in mind. So Jess, why don't you take this?
So when should we pause? does somebody have a home?
I just like hearing the New York accent,
Oh,
the pause part come out.
I was in Long Island for about a month and a half, and my vocal cords are like marinating in Long Island. So it's just kind of when if somebody has a home, if they have a home and they kind of want to stay in the home, that should definitely be a clue, or they want to keep the home. Those are all factors. If most of the wealth is tied up in the house, they don't have assets, they don't have additional assets, or they don't want to sell them because they're in the market and it wouldn't be a good time to do that, or they want to keep those. If there's siblings that are arguing, like I'm kind of guilty being a pigeon sibling where I don't live by my family, but because I have experience in the industry, I can fly in, do my crap all over the place, and then fly out. But the reality is some family members disagree because they have different ideas, or there's different ideas or levels of education on this, right? So sometimes you need somebody from the outside to come help the family make a decision. Are you making this through a crisis? Is this an emotional time for that person or the family? And do you want to hear about options? I think that's the thing too, is um, you can call Mark or get in touch with us if you just have a question. And if that question is, how do I find somebody like you in our area? Yeah, I don't know if you can, but like we'll do our best, because we want to collaborate. We want people to get this education. But it's a matter of just you kind of understanding, like, I just want to check with this if this family has any other options. Like, we're definitely here for you.
Absolutely. Absolutely. So, and this kind of alludes more to the different types of professionals that should be collaborating in some capacity, or at least family members should be collaborating with them. Hopefully, again, the ideal scenario is when the professionals are also collaborating independently of the family to make sure that they're anything that they might recommend doesn't clash with something that somebody else might recommend in a different space. So we are big proponents of having a proper team around families to be able to make these decisions, even if it's not a permanent team that you're connecting with all the time. When you have these major decisions that you're making, those are the moments where you really need to collaborate with the right professionals. So and obviously we're available to help anybody that needs assistance. Our goal today was really education, not to promote ourselves, but I think if families or professionals that are on the call today have questions, this is a great way to connect with us. You can scan the QR code and schedule a consultation if you'd like, but at this point I think we should open it up to questions.